Top 20 Credit Analyst Interview Questions and Answers. Mastering credit analysis requires sharp financial acumen. Here are the top 20 credit analyst interview questions with detailed answers to help you assess risk, evaluate financials, and make informed lending decisions confidently. 1. What are the key financial ratios you analyze when assessing a borrower's creditworthiness? When assessing a borrower's creditworthiness, I focus on several key financial ratios. These include the current ratio and quick ratio for liquidity, the debt-to-equity ratio for solvency, and the return on equity (ROE), and net profit margin for profitability. I also evaluate the interest coverage ratio and debt service coverage ratio (DSCR) to determine the borrower's ability to meet interest and debt obligations. Analyzing these ratios over time helps assess financial trends, operational efficiency, and the borrower's capacity to repay debt, enabling a comprehensive risk evaluation before recommending credit approval. 2. How do you evaluate a company's liquidity, solvency, and profitability? To evaluate liquidity, I examine the current ratio and quick ratio to assess the company's ability to meet short-term obligations. For solvency, I analyze the debt-to-equity ratio and interest coverage ratio to understand long-term financial stability and the company's capacity to meet debt obligations. Profitability is assessed through metrics like gross profit margin, operating margin, return on assets (ROA), and return on equity (ROE). These evaluations help paint a complete picture of a company's financial health, indicating its ability to generate earnings, remain solvent, and operate efficiently under various market conditions. 3. Can you explain the 5 Cs of credit analysis? Character, capacity, capital, collateral, conditions. The 5 Cs of credit analysis provide a comprehensive framework for evaluating credit risk. Character assesses the borrower's reputation and credit history. Capacity measures the borrower's ability to repay based on income or cash flow. Capital evaluates the borrower's investment in the business, showing commitment. Collateral is any asset pledged to secure the loan, reducing lender risk. Conditions refer to macroeconomic and industry-specific factors that might impact repayment. Together, these factors help determine the level of credit risk and shape the decision-making process for loan approval or rejection. 4. What's the difference between secured and unsecured loans? How does this impact risk assessment? Secured loans are backed by collateral, such as property or equipment, which lenders can claim if the borrower defaults. Unsecured loans, in contrast, are not backed by assets and rely solely on the borrower's creditworthiness. This difference greatly impacts risk assessment. Secured loans are generally considered lower risk due to asset protection, leading to more favorable terms. Unsecured loans pose higher risk, requiring more stringent credit evaluations and often higher interest rates. Assessing a borrower's financial stability, cash flow, and credit history is critical when evaluating unsecured loans, as lenders lack asset-based recourse. 5. How do you assess the credit risk of a company with inconsistent cash flows? Assessing a company with inconsistent cash flows involves deeper scrutiny of cash flow statements and historical financial trends. I analyze cash flow patterns to determine causes, seasonality, market shifts, or operational inefficiencies. I look at liquidity buffers, such as cash reserves and lines of credit, and assess working capital management. Financial ratios like DSCR and interest coverage are also reviewed over multiple periods. In some cases, I apply stress testing to forecast performance under adverse conditions. Understanding management strategies to stabilize cash flows is vital to determine whether the risk is manageable or excessive. 6. What financial statements do you rely on most, and why? I rely primarily on the income statement, balance sheet, and cash flow statement. The income statement shows profitability trends and revenue generation. The balance sheet reflects financial position, including assets, liabilities, and equity, helping evaluate solvency and leverage. However, the cash flow statement is particularly critical for credit analysis because it shows actual cash generation and usage, indicating a borrower's ability to service debt. Together, these 3 statements provide a complete picture of a company's financial health and support data-driven decisions on credit risk and loan structuring. 7. How would you determine if a company is over-leveraged? To determine if a company is over-leveraged, I evaluate its debt ratios, particularly the debt-to-equity ratio and interest coverage ratio. A high debt-to-equity ratio suggests reliance on debt financing, increasing financial risk. I also examine the debt service coverage ratio, DSCR, to see if cash flows adequately cover debt payments. If these ratios indicate strain, and interest payments consume a large portion of earnings, the company may be over-leveraged. Trend analysis and industry benchmarks further clarify if a leverage level is excessive relative to peers and market conditions. 8. What is debt service coverage ratio, DSCR, and why is it important? The debt service coverage ratio, DSCR, measures a company's ability to meet its debt obligations using operating income. It is calculated by dividing net operating income by total debt service, principal and interest. A DSCR above 1 indicates sufficient income to cover debt, while a ratio below 1 suggests potential shortfalls. This ratio is crucial in credit analysis as it reflects a borrower's financial cushion and risk of default. It also helps lenders determine appropriate loan amounts and terms, ensuring the borrower's cash flow can support repayment obligations under realistic scenarios. 9. How do macroeconomic factors, e.g., interest rates, inflation, impact credit risk? Macroeconomic factors significantly influence credit risk. Rising interest rates increase borrowing costs and reduce profit margins, impacting a borrower's ability to repay. Inflation erodes purchasing power, which can compress revenues and increase costs. Economic downturns may result in lower consumer demand and declining sales. Additionally, currency fluctuations and geopolitical instability can affect importers, exporters, and companies with international exposure. As a credit analyst, I consider these factors when forecasting future cash flows, adjusting risk ratings, and recommending risk mitigation strategies such as loan covenants or shorter repayment periods. 10. Describe a time when you identified a red flag in a borrower's financial statements. In one case, while reviewing a borrower's financials, I noticed a sudden drop in revenue alongside an increase in accounts receivable. Upon further analysis, I found the company was recognizing revenue prematurely to boost reported earnings. This aggressive accounting practice raised a red flag regarding management integrity and financial sustainability. I escalated the issue, conducted further due diligence, and recommended withholding loan approval until the company provided restated financials. This decision helped the institution avoid potential credit losses and demonstrated the importance of scrutinizing anomalies in financial data. 11. Describe a time when you had to reject a loan application. How did you communicate this decision? I once reviewed a loan application from a small business with poor cash flow, high debt levels, and an unstable revenue base. After a thorough analysis, I determined the borrower lacked the capacity to repay the loan. I prepared a clear, data-supported explanation outlining the specific financial risks. During the meeting, I communicated the decision professionally and empathetically, offering constructive feedback and advising the borrower on steps to improve financial health. This approach helped preserve the relationship and encourage the borrower to reapply in the future under improved financial conditions. 12. How do you handle conflicting data when assessing a borrower's credit risk? When I encounter conflicting data, such as discrepancies between tax returns and internal financial statements, I begin by verifying the accuracy of each source. I request clarification from the borrower and may consult external auditors or obtain third-party reports for validation. I also look at historical trends and industry benchmarks to contextualize the data. In cases where uncertainty remains, I apply a more conservative approach in my risk assessment. My goal is to make a balanced, well-supported decision that minimizes risk while maintaining fairness and objectivity in evaluating creditworthiness. 13. Tell me about a high-pressure situation where you had to make a quick credit decision. During a major client acquisition, I was asked to provide a credit assessment within 24 hours for a time-sensitive funding request. I quickly gathered and reviewed the financial statements, credit reports, and industry data. Despite the tight deadline, I performed key ratio analyses, stress-tested cash flows, and checked existing exposure. By staying focused and efficient, I identified manageable risk levels and recommended a conditional approval with tighter covenants. The decision helped secure a valuable client without compromising credit standards, showcasing my ability to deliver under pressure with accuracy and composure. 14. How do you stay updated on industry trends affecting credit risk? I stay current with industry trends by regularly reading financial publications such as the Wall Street Journal, Bloomberg, and industry-specific reports. I also attend webinars, training sessions, and credit risk conferences. Regulatory updates from sources like the Basel Committee and local financial authorities help me stay compliant. Networking with peers and participating in internal knowledge-sharing sessions provides insights into emerging risks. This proactive learning enables me to adapt credit models, anticipate market changes, and make more informed lending decisions in a constantly evolving financial landscape. 15. Have you ever disagreed with a colleague or manager on a credit decision? How did you resolve it? Yes, I once disagreed with a manager who wanted to approve a loan I viewed as high risk due to weak cash flow and industry volatility. I presented my concerns with supporting financial data, ratio analysis, and potential red flags. I also proposed alternative structures such as requiring additional collateral or reducing the loan amount. Through open dialogue, we reached a compromise, approving a smaller loan with stricter terms. This experience reinforced the importance of collaborative decision-making and data-driven discussions in achieving balanced credit outcomes while maintaining strong working relationships. 16. What steps do you take to mitigate credit risk in your analysis? To mitigate credit risk, I start with a thorough financial and qualitative assessment of the borrower, including evaluating industry risk, management capability, and market conditions. I perform stress testing to model performance under adverse scenarios. I recommend covenants, collateral requirements, and conservative loan structures when necessary. I also monitor borrower performance post-loan through periodic reviews. Using credit scoring models and risk rating frameworks helps maintain consistency. These measures ensure that risk is identified early, mitigated effectively, and managed throughout the life of the loan to protect the institution. 17. How do you ensure compliance with lending regulations, e.g., Basel III, Dodd-Frank? I ensure compliance by staying informed on regulatory frameworks such as Basel III, which emphasizes capital adequacy and liquidity, and Dodd-Frank, which addresses transparency and consumer protection. I follow internal credit policies aligned with these regulations and incorporate regulatory checks into my credit evaluation process. I work closely with compliance teams to validate that documentation, underwriting standards, and approval processes meet all legal requirements. Regular audits, training, and system updates further ensure adherence. This diligence helps avoid penalties, supports sound risk management, and reinforces institutional credibility in the marketplace. 18. What's your approach to stress testing a borrower's financials? My approach to stress testing involves applying hypothetical adverse scenarios, such as revenue declines, interest rate hikes, or increased operating costs, to a borrower's financials. I assess the impact on cash flow, profitability, and key financial ratios like DSCR and interest coverage. This helps determine how resilient the borrower is to economic shocks. I also consider industry-specific risks and historical volatility. The results guide my recommendations for loan structure, such as shorter terms, higher collateral, or tighter covenants. Stress testing is a crucial tool for anticipating risk and ensuring long-term creditworthiness. 19. What industries do you have experience analyzing, and what unique risks do they present? I have analyzed companies in manufacturing, retail, real estate, and healthcare. Each industry has unique risk factors. Manufacturing faces supply chain disruptions and capital intensity. Retail is vulnerable to consumer trends and seasonality. Real estate involves market cycles and asset liquidity. Healthcare depends on regulatory changes and reimbursement models. Understanding these sector-specific risks allows me to adjust my credit approach using different financial benchmarks, risk thresholds, and mitigation strategies. Industry expertise ensures more accurate credit decisions and helps anticipate external factors that may impact a borrower's ability to repay. 20. How do you balance risk and profitability when recommending a loan approval? Balancing risk and profitability involves aligning credit terms with the borrower's risk profile. I assess the borrower's financial health, market position, and repayment ability to determine acceptable risk levels. If the borrower presents moderate risk, I may propose higher interest rates, stronger covenants, or collateral to protect the lender while maintaining competitive terms. I also evaluate the strategic value of the client and potential long-term returns. This approach ensures the loan supports portfolio growth without exposing the institution to undue risk, enabling sustainable profitability and credit quality. Mastering these 20 essential credit analyst interview questions equips you with the financial expertise to assess creditworthiness, mitigate risks, and make informed lending decisions. Whether you're a hiring manager or candidate, this guide ensures confidence in evaluating financial health, industry trends, and regulatory compliance. Stay ahead in credit analysis with these key insights.